Students, I am S.V. Chinchini, Associate Professor, Government First Grade College, Dandeli. Today, I have taken for discussion reconciliation statement. What is the meaning of reconciliation statement and how we are reconciling the profits of both the financial accounting and cost accounting. In medium and large scale businesses, maintenance of both the sets of accounts, that is cost accounting and financial accounting, is made mandatory. And as these two methods are different in their approach, for the same business, for the same year and for the same information available, the profits arrived by one book of accounts differs from another book of accounts. Therefore, reconciliation is essential. Then if this is so, what are the reasons that make the difference? That is what our concern. The cost account books, they consider certain items, whereas some other items are not considered. For example, notional rent, notional salary, notional interest on capital. These are all imaginary expenses which are considered in cost accounts, which are not taken into account in case of financial accounting. Similarly, there are purely financial incomes and expenses which are not taken into account in case of cost accounting. Because of that, there is a difference. Apart from this, there is a possibility of overvaluation and undervaluation of opening or closing stock in both the sets of books. That also leads to a difference. And finally, depreciation. The policy of depreciation, and because of change in the policy of depreciation, the amount of depreciation varies in both the sets of books. Therefore, there is a difference in cost accounts and financial accounts. If this is the case, then what is the procedure of preparing or reconciling the statement? Reconciliation statement preparation needs information on 2 points. One is which profit is to be taken as a base profit, and what are the items to be added to that profit, and what are the items to be deducted from that profit so that we arrive at end profit. If cost accounting profit is taken as a base, then what are the items to be added? Are like this. These are the items which reduce the cost profit. Now they are added back. For example, first one, over recovery of overheads in cost accounts. It means when cost accounting profit is taken as a base, if any overhead which is charged more or recovered more in case of cost accounting, as it reduced the profit, now it is to be added back. Second item, as I told, notional items. It may be rent, it may be salary, or it may be interest on capital. All of these notional expenses, they are reducing the profit in cost accounts, hence they are to be added back. Third one, abnormal items. Certain abnormal items are, if considered in case of cost accounting, which have no place in financial accounting, those items also reduce profit in cost accounts, hence that is to be added back. Similarly, overvaluation of opening stock in cost accounts and undervaluation of closing stock in cost account, they reduce the profit in cost accounts, hence these are the items to be added back. Finally, because of depreciation policy, if excess depreciation is charged in cost accounts, that has reduced the profit, now it is to be added back. So these are the examples or the reasons which have reduced the cost in cost accounts, therefore they are to be added back. Apart from this, there are another category of items which are not taken into account in cost accounts, and these are the incomes which are taken only in the financial account, because of including these items in the financial account, the profit in the financial account is more, and naturally profit in the cost account is less. Therefore, these items are now to be added back. Examples: dividend received, share transfer fees, interest on deposits, profit on sale of fixed assets, and donations received. As these are all income items which are not taken into account in cost accounts, therefore they have reduced the profit in the cost accounts, hence they are to be added back. Similarly, there are certain items which are to be deducted from the profits of cost accounts, which we list as follows. First one, under recovery of overheads. If in the cost accounts, overheads, if they are under recovered, naturally the profit in the cost accounts is more, and that is to be deducted. Similarly, notional income. Any income which is taken as a notional, imaginary, that is to be again deducted in the cost accounts. Abnormal gain, if it is taken into account in cost accounts, so it is to be deducted. And undervaluation of opening stock in cost accounts, overvaluation of closing stock in cost accounts, they have increased the profit in cost accounts, therefore now they are to be reduced. And lesser amount of depreciation, if it is taken in cost accounts, it is to be now deducted. There are certain items which are not shown in cost accounts, like dividend or bonus paid, income tax, reserve for doubtful debts, interest on debentures, and loss on sale of fixed assets. All these are the expenses which are charged only in financial account, and now because of these items which are not charged in cost accounts, the profit in the cost accounts is more, and these are to be now deducted. And after making all these add and less adjustments, when the cost profit is the base, the final result will be the profit as per financial account. So in this way, reconciliation statement is to be prepared, taking into account which is the base profit and what is the item which has increased the profit, now it is to be deducted, and what is the item which has reduced the profit of base profit, now it is to be added back. In this way, reconciliation is prepared. Sometimes reconciliation is also prepared in the form of account. We call it as reconciliation account. The procedure is same. So on the credit side, we take the cost of profit as a base, and all items which are to be added to this cost profit, they are credited, and those items which are to be deducted from the cost profit, they are to be taken on the debit side. And on the debit side, what is the difference? The difference will be the profit as per financial accounts. Now, suppose if we take the base as costing loss, then whatever items which are added when taking base profit as cost profit, now all the items are to be deducted, and those items which were deducted by taking cost profit as a base, now they are to be added back. So this we call as reverse adjustment. If you take the costing profit, you are adding certain items which now taking costing loss, they are to be deducted, and those items which are deducted while taking costing profit as a base, if costing loss is there, the same items are to be added back. In this way, so effect of every item on the profit or loss is to be ascertained, and thereby we are preparing reconciliation statement. To remember this one rule can be applied. For example, what is the base profit we are taking and what is the end profit we are arriving at? When you are taking costing profit as a base and you are arriving at financial profit at the end, now the rule to be applied is less to more. It means because of any item, if the profit in the cost account is less and you are arriving at the end profit is a financial profit, that is to be less to more, more that is to be added, and more to less, less. It means because of any item, if the profit in the base, that is cost profit, is more, now we are arriving at financial profit, so more to less, less that item is to be deducted. For each and every item, this rule can be applied, and thereby we can reconcile the profit arrived by cost accounting books and financial accounting books. Thank you very much.